Welcome. This is your everyday trader. Yep. So basically today, I'm just gonna cover make the first video to basically be a reference point for beginners, people that's starting off their trading journey within the financial markets. So today's topic will be covering technical analysis, because obviously that's one of the not the whole subject as a whole, but just parts of it, and obviously the beginning parts of it. So I'm just gonna try to give an easy delivery, and hopefully by the end of it you'll learn something from it. What I want to cover today is literally what is a candlestick? Basically, what a candlestick is these little funny little looking things that's right in front of me, or in front of the screen, as you can see. So basically, just what is the definition of a candlestick in my opinion? It's a representation of price in that particular trading period. So, for example, this chart here that I'm looking at, sorry that I didn't even mention what we're looking at here. So this is the British pound against the American dollar on the monthly time frame. So basically, each candlesticks here represent what's happened during that trading session, where price has opened, closed, and how high it went and how low it went during that particular time. And we use this information to basically decipher if price is going to continue to go down or go up, or is it going to go sideways. So candlesticks give us that first step of understanding what price has done on that particular time frame, or what I say during that particular trading period. So that's probably like the easiest way I could explain that. Let me also just give you an example. So you can obviously see this is where the opening price was on that line there. This is the close price. This is the high of that. So basically, this is the highest point price traveled up to during this particular trading session. And obviously, this little shadow here, wick to the downside, is the lowest price was trading at during this monthly trading session. That hopefully that basically gives you a better understanding in terms of what a candlestick is, and what it represents. So next thing is basically this is so you must be thinking, what is this? This is basically a bar chart. Or a different format to candlestick. Obviously, it does the same thing. Like I said, this is a representation of price, the opening, the close, the highs and the lows. Only on this one it's a little bit different. So you can see, for example, let me do this candle here. So the left dash to the left represents the opening, and then the one to the right dash to the right represents the closing price. So you can see on this particular candle, this was a buy candle, or we could say a bullish candle. And this one represents that the buyers came on top, and obviously that just slightly below the opening price, that was the lowest, and then slightly below the close price, that was the highest of that particular candle on that monthly trading session. So that is literally there's no difference between the two. It just basically just how they look. One looks different to the other, but they basically just represent the same thing. So you can use that depending on what you feel looks better to you, or you feel like you can see more clear out of the two. So that's about it for candlesticks and bar charts. So that's been covered now. I think that's obviously important to just understand that concept. What the two represent. There's other more than bar chart. There's like hollow. What's it called? Hollow. Let me just double check. Hollow candles, Heikin, Ashi, line. Obviously the line charts as well. So there's several. So basically they all represent the same thing, as a representation of price, open, close, high and low, Yeah. So yeah, we're back on the candlesticks. So yeah, another thing that I would like to cover is basically how do you identify trends. So this is another vital part of technical analysis. This is where you decide whether you're going to be buying or whether you're going to be selling, and how do you know if you're going to be buying, and how do you know if you're going to be selling. This is what I'm going to cover now. So we use something called high lows and high highs, and then we got the lower highs and the lower lows. So literally just to cover the two very quickly. One represents if price is going to keep going up, and one represents if price is going to keep going up. And we call we call it an downtrend for price going lower, and we call it an uptrend if price is going to keep going up. So basically, what I've drawn out this little picture thing, which says lower lows and lower highs, and obviously with arrows, sorry, with lines going in a zigzag motion. That is basically a definition of a downtrend in terms of the requirements it holds for you to understand that price is going to keep going down. So if you have a look at this, so we see if we start from here, price has been doing a massive sell-off, for example, and this is the lowest point before price makes a little something we call a pullback. A pullback basically means this is where when prices hit this low, what happens is that many investors would take some of the profits out. So what will happen is that the momentum in price will slow down to the downside, and therefore people, smart money, other investors that believe price is going to go higher will obviously buy the price, and then you see the shift in momentum slightly, and then it will favor the buyers, pushing the price higher. So basically, in retrospect, what this means is that people that sold from here and taking their profits out, what will happen is that they're just waiting for price to travel up a little bit further up before they sell off again. So the people that are buying, it's a short-term buy if you was going to buy from this low point, and then obviously it gets to a certain point where the momentum starts to fade and a lot of sellers start to jump into the market again, and this is what happens. Then the price gets pushing down. So that's why we call it a lower low. So that's the lowest point of the low, and the lower high. So this is the lower, so the highest point of the lower. So basically, it will never transcend further up. So let's say, for example, if this here was a lower high, we need to for it to obviously qualify as still as a downtrend. The lower high can't go above this level here. So it does a lower high and then the lower low. So the reason why this one is called the same thing as that lower low is because this point here is lower than this one, yeah. And then the same thing happens again, and then the lower high, it does not go beyond this point here, and then so it carries on. So basically, in order to invalidate this downtrend, for us to understand, okay, this downtrend is not valid anymore, what will happen is, let me just show you quickly. Something like this has to happen where price, once it has hit that lower low, the low point, you will see another shift in momentum and price will push up. If price rallies, basically goes beyond this lower high, then there is a possibility that we can see a shift of trends. And in for us to see that shift in trend, this is what we would like to see. Let me just draw that out. So yeah, it's all drawn out now. So yes, as I was saying before, to invalidate a downtrend, what will happen is that you see once obviously that lower low has been fulfilled, what happens is obviously, like I said, like I explained in these scenarios, is that there will be a lot of profit taken from people that have sold here, and what happen is there is a potential shift in momentum, and what can happen is that this move becomes either short term or it becomes a break of market structure. And what I mean by that is that for this indication here, this lower high, once price has exceeded that lower high, that gives us a strong possibility or a possibility that price can potentially change trends, yeah, because the lower high has been taken out. And that's what I was explaining earlier. In order to keep validating a downtrend, the lower highs has to be intact, so they can never be exceeded further, yeah, in order for then price then to make the lower low and the lower high, the lower low and then lower high. But in then this instance, you can see price exceeded it, so it gave us a potential. So a lot of sellers or investors in general could either look at it two ways: that this is just a mask that are, unfortunately, I think we held on the hands too long, and we didn't get in the right time. So that's the reason why price exceeded that lower high, and price will potentially keep going further past the lower low. Or the second point would be it's a break in market structure, and what will happen is that we will see some short-term selling because people that would have bought from this level would have rode away all the way up here past this level and obviously taken their profits now. Yeah, and what would have happened at this level? This selling cycle is that it would have been a short-term selling cycle before price. People, investors would have reloaded once again, and new investors seeing the momentum shift, so they are now confident that price will now ride the wave to in an upward fashion, and that's what basically happens. So you see now this higher low exceeds that higher high, so therefore now this is the new higher high. And then in order for us to carry on this same trend, this uptrend, same thing again, high low and then high high. So yeah, I hope this gives you a good understanding or just a basic overview of basically how a downtrend works or how an uptrend works. So basically this is vice versa. For example, in order to invalidate an uptrend, basically the high low can't be exceeded. Obviously there's much more into this to obviously determine an upturn and downturn, but these are the basic fundamentals that you need to be aware of to understand and identify the trend. So what I'll do now, after I've given you that a bit of an overview, so I'm just going to give you an example on the chart, on the candlestick chart, because this is obviously where it matters, because obviously there's a line up and down in a zigzag formation. It's not really going to show you how to spot an uptrend or a downtrend. So yeah, I'll use these two arrows. So the green arrow to signify high low, and then the red one to do high high. So let's start from here. So this here, after you can see price has accumulated or been in the sideways market, meaning it hasn't really gone anywhere. So price went up, went down, went up, and then down. So now we see this is where this is the next stage where price has moved up to this level here. So this now has become the higher high, and this is the higher low. So let me just give you a few examples just so you get the picture. So now this here becomes the higher low, and this here becomes the higher high. Then this here becomes the higher high, higher low, and this here becomes the higher high. And now this, I would say even this here, that becomes the higher low, and now that becomes the higher high. Yeah, same thing again. This here becomes the higher low, and now this here, because this level is higher, than the previous one. Just give you a show you, so you can see here. So it's exceeded that level there, so that becomes the higher high. Yeah, and I'm just going to do the same thing for the downtrend, how that is identified. So we'll use the red arrow for the lower high and the green arrow for lower low. So obviously we're riding this wave, as you can see. We can even use this here. That is the lowest point. Then you see, like I explained, people taking their profits, and then price pushing up, temporary buying, and then what happens? Here, what happens here? Price has dipped down to this level, and this is now the lower low, and then this here is the lower high, and then we have this here, the lower low, and now this here, the lower high, and then finally, before we see a shift in trends, this now is the last lower low. So yeah, that basically explains the downtrend from candlestick perspective. I hope this video has been informative. So in the next chapter, I'm just basically gonna explain to you the third alternative, what happens. Obviously there's an uptrend, there's a downtrend, and then you have something called a sideways or a range bound market. This is basically where price is literally going up. It's literally trapped within the zone. But what I will do, I will explain it more in the next video, because I don't want to make this video for too long. I've been rambling on for about 17 minutes now anyway. But yeah, I hope this this video will become informative for yourself, and yeah, stay tuned for the next one.